So yeah, I'm here from, I teach at a place called Hobart College. I'll be talking about that a bit more. Jess has done a fantastic job with about some of the details of exchange rates. I'm actually going to focus a bit more on students because I think it's getting to know your content and the course is one thing, but getting to know your students is another thing. And I think that's something that develops over your whole career. So it's getting to know your students, I think, is the big challenge for all teachers. What's their background knowledge? How can I make them interested? How do I make sure everyone knows the basics, especially for your C kids, your B kids, without boring the ones who have a pretty good idea? How do you deal with the students that have missed the last couple of lessons? That critical sort of stuff, the foundational sort of stuff, and you want to move on. It's the problem with every subject, really. It's not just an economics problem or an exchange rate problem. And also how to extend your stronger students. We've got all these sort of challenges that we face in the classroom. And so I think it really varies in what we do and how we do it. So there's general teaching challenges, there's difference between students, there's difference between schools, there's difference between systems, there's differences between states. And I teach at Hobart College, and so we're on like a small mountain overlooking, and we can see Mount Wellington in the distance. It's a pretty high-performing public school in the Tasmanian context. And I get a lot of really strong students at my school because economics it's one of the highest ATARs. I'm sure that's common for you. And those kids are interested. Sometimes they do economics, they want to get into medicine, or they want to go to mainland unis or get scholarships, that sort of stuff. I've had 3 Tuckwell Scholarship winners in the last couple of years. 2 of my students have gained State Treasury cadetships. So I've got some pretty high-performing sort of students, but we've also got like a big bottom end as well, and we want to look after all of those kids as well and help them understand a bit more about the world. So it's quite a varied sort of classroom, and I'm sure a lot of you are sort of in a similar sort of situation. In terms of background, I sort of assume that they know nothing. There is Tasmania adopts the national curriculum, and there's nothing on exchange rates here. There's a little bit about trade, but it's very, very likely that most of my students wouldn't have done any of this. It's just not touched on in high schools. The high schools don't tend to want to go there. But I do get a lot of students that move from the private sector in year 10 to the public system in year 11 and 12. And so I get a lot of students that, a lot of those schools do have good business and economics education in years 8, 9, 10, etc. So some of my kids will be quite strong in this, some won't have a clue. So how do you tailor for that? You might have some students that have travelled overseas, and so they've got a bit of a clue. But there's some kids like from the Huon Valley, for example, who have never been to the city centre. That's an aspect of Tasmania that I sort of need to deal with. And that would be particularly true on the northwest coast of Tasmania, where a lot of people are very they can be insular at times. Just in terms of the way I teach, I use a Microsoft OneNote class notebook. I just use it because it's an electronic platform. I can add pictures and clips and URLs on the fly. I can annotate, I can mark up. The other benefit of this is this platform that I use to prepare my notes, and then I teach it in the class, and then it's there for them later on. And so it's just this ever expanding sort of thing, with hundreds of pages by the end of the year. And I can, there might have been a statement on monetary policy released the day before. I whack it in there, I can annotate it and talk about it live. And I just find that's a much better way of dealing with the content than an LMS. LMSs are so much more static and hard to do. So things like that are really, really good. And so there's literally hundreds of pages at the end of the year of content for students. And so that's great for all those students that are absent in particular lessons. It's great for the students that have missed lessons and who want to catch up later on. And I've had other teachers ask me, especially at my school, does that mean that kids don't bother coming because they know it's all going to be there? But I think it's actually had the opposite effect. This communicates that there's a truckload of stuff that we do every day, and you better be there. They're scared basically when they look at this and they think, well, I'd better come to class. So I just thought, this is about teaching, not just exchange rates, but teaching in general. It's just good to think about how we do these things. So this is like a snapshot of my scope and sequence. And I just put this up there, if you look at the dates, September. I just want to make the point that states vary, and how you teach exchange rates is really going to be quite different depending on when you teach them. So in Tasmania, it's the last thing we do. So we've got the benefit of like all the stuff that we do early on, and like exchange rates enrich and added and helps explain things that we've previously done. Our final unit is on international aspects, and I know a lot of states that's like a fair bit earlier, and that's a bit different. And we start with globalisation. There's a bit of trade, benefits of free trade, arguments for protection, all that sort of stuff. So it sort of comes, it's the culmination along with the balance of payments sort of stuff. And like from year to year, I toss up, do I do BOP first? Do I do exchange rates? And I swap around. I'm not sure which is the best way to go. But it just means that my students have got a lot of skills and knowledge. They're familiar with supply and demand graphs. We've been talking about aggregate demand like for ages, and I've sort of been like leaving off the X minus M bit at the end, sort of saying, oh, we'll worry about that later on. And then, we get to the trade section and I'm talking about the X minus M bit. So it rounds things out really nicely. But if like you do if you do the exchange rates before you do that macroeconomic stuff, there'll be different benefits, like there'll be disadvantages and there'll be benefits for you. But I think this idea that we're making a connection between, sort of like for us, it's unit 2, that domestic macro stuff and this, it's really good. It's like what I love teaching about economics is that you're reactivating these concepts. It's like a snowball. It gets bigger and bigger over the course of the year. And you're getting students to think about aggregate demand in a different way when you're teaching about, how exchange rates might affect that. And that's sort of making additional, educational sort of stuff here, but associations and elaboration, like the students are coming to this knowledge from different angles, and so they've got more neural network sort of connections. Those associative networks are bigger and better, and so it improves their ability to sort of like to recall and apply the information in these novel applications. And that's the sort of things that we want our students to be able to do, to just to be able to think about something and think about how it applies in this different sort of situation. So I did a very quick sort of survey of some of the states, and I realised that you've got freedom to sort of like change things around to some extent. Like your courses might say you do this unit first, but there's going to be some freedom to swap things around. But just going off official documents, we see that students are exposed to this concept at different stages of their economics education. I wasn't going to do a full survey, but I ended up sort of doing everyone but New South Wales and Victoria. I thought I was going to offend someone, so I'll go big and offend the 2 biggest states. But WA, I think we have only one WA representative here, but my understanding is that you do the micro stuff in year 11, and I just did a quick control F. I didn't do a detailed analysis of your course, but I couldn't find aggregate demand mentioned in year 11. I'm sure it gets mentioned. I'm sure like you wouldn't sort of like skip that at all. And year 12, you do the international side of things first, and then the domestic economy later on. South Australia, a little bit different, micro stuff in year 11. There's also some trade stuff that seems to be done in South Australia in year 11. And exchange rates are dealt with in the context of macroeconomics. I'm sure that exchange rates are mentioned in that year 11 sort of stuff on trade, but that's up to individual teachers and how they choose to put it all together. So South Australian students are doing it at a similar time to Tasmanian ones, but the path that they're getting there is different. The associations and like the order that's going to change. Queensland, I thought this was interesting, and I might be wrong about the way this works, but it looks like it looks at the global economy in Unit 3 at the beginning of Year 12. And I couldn't find any reference to exchange rates in the ACT. Maybe they don't worry about them there. This is just a snapshot of our course documents, and I just wanted to put that in because it's probably as painful and as poorly laid out as all of your documents. It's really not student friendly, and I think we need to sort of do our best to help our students to sort of like decipher and wrestle with these course documents. So this point over here, I've had students sort of contact me the day before the final exam and say, what does this mean? Effects of a change in the value of the domestic currency on the allocation of resources to alternative sectors of the economy, especially on labour flows. And it's just a really simple concept. Just say, well, if there's a meaningful change in the value of the Australian dollar over time, the kinds of things we export, the kind of things we import are going to change, and there'll be a change in where the jobs are. But our course documents often don't do us a favour. It's not a very complicated idea, but they've managed to make it sound really tricky. But I do want my students to sort of wrestle with the course documents. But I will also do things like this, present them in sort of a bullet point format, maybe simplify some of the language, just to say these are the main things that we cover. And I'm really putting the onus on them. You need to make sure that you understand, like, when did I talk about this? Like, I'm drawing attention to that in that lesson, but at the end of that, I want them to sort of be able to tick that off. And if there's a bullet point that they think, we didn't do that, I want them to sort of like let me know. Another reason I think that's important is that, the course document's the only point of truth for the whole course. It's the only thing that the teachers, the students, the exam writer, the exam marker, it's the only thing that we all have in common. We don't actually have a textbook in Tasmania. We sort of use the O'Mahony sort of like book, but because it's made for HSC, there's a lot of bits that's not relevant for us. Anyway, getting to definitions. A teaching practice I use is to ask students to memorise definitions, and I try and make them short and sharp and memorable, and I try and make them so that they're not fully self-explanatory, like they need to be elaborated on. And, it's a great way to start our short answer questions, and like it's also like money for jam. Like you'll get some marks, you'll get a certain number of marks, bang, for a quick, short, sharp definition. But then if that definition sort of like leaves lots to be explained further, there's an elaboration, and that's their cue. They can build on their definition. And I'll give them maybe 2, 3 definitions for some different sort of like concepts to see where the different emphasis comes from, different terms. And you can sort of say, hey, look, this is talking about the same thing, but just from slightly different angles. And I think there's a lot you can do with simple definitions. And I invite them to sort of explore their own sort of definitions as well, just because it needs to stick for them. Now, just one thing about this, like I really want to sort of, I'm going to harp on about this a lot, but to the extent to which students don't have the same knowledge and understanding and background that we do, the things that we take for granted. Now, what's the price of a currency? It's sort of like it's fine for us, but it's a bit weird for students. And so I think talking about currency pairs helps. Instead of talking about the exchange rate, well, there's not an exchange rate, there's lots of exchange rates. And you look at something like this is from the RBA side, on their, I think this is the TWI sort of various currencies, but just the variations here. You've got some are 0.6 to the Aussie dollar with the Thai baht and the Vietnamese dong. You've got like 10,000 currency units and 16,000 currency units. Just the range is sort of bewildering. And like we need to give context to economic data. So when we're studying unemployment, for an example, students learn over time that 24.3% unemployment is sort of like, whoa, that's plausible under certain circumstances. It might be youth unemployment in regional areas. Like you might do a calculation and you get that number and yeah, that'd be okay. But normally that would be a weird unemployment rate. And we also know that negative 3.4% unemployment, they've made a mistake somewhere. So what's the right range of numbers? And there's no right range of numbers here. There might be like a common sort of like range for the US dollar, the euro, whatever. But yeah, it's good to have that familiarity, and it's hard to get that. I think it's also an opportunity to talk about how these numbers tell you absolutely nothing about the purchasing power of a currency or about the relative strength or how it's changing over time. It's just a snapshot. Absolutely tells you nothing. You have to use other data. That's what I appreciated about the unemployment talk actually this morning, like all those different measures of unemployment, like to get a broad picture of the labour market took a huge number of different data points and some of the leading sort of things as well. So one way to get this across is obviously with changes in the Australian dollar over time. The other is to look at purchasing power. And if I've got time and if the students are interested, and remember that my exams are coming up, we're at middle of term 3 by the time we get to this, I might discuss something like this, something like the Big Mac Index as a way of getting this purchasing power parity theory across. But I don't actually need to for our exam. It's not in our course. It's just something which I think might help aid with understanding. And I think this goes to a concept or an issue that we face as economics teachers. I'd like to see a show of hands. Who here goes like above and beyond their course documents, their syllabus, because they feel they need to? Because there's a concept which they have to go and explain more about. I'm getting a lot of nods here. Yeah. My personal example, comparative advantage, is in our course document, along with calculation of it, but absolute advantage isn't there. And I sort of think, well, you've got to have, for me, you've got to have absolute advantage as a stepping stone to understanding comparative advantage. So we end up introducing these things that don't necessarily, or aren't in the course document, but we feel that our students need to know these in order to have this understanding of other things. I'm sure a lot of you, I'd be in similar sort of like territory with this, is that you don't know if you're going too far with this sort of extraneous material, and there's got to be a good reason for it. And I think when I was starting out, I was probably, guilty of sort of like showing off, like, felt insecure about some of my areas of knowledge and thought, I know heaps about this thing, so yeah, I'll blow them away. And look, I've stepped back from that. And it can also be tempting to engage with those really sort of like, engaged students. But I remember I had a couple of kids last year and I could just see the rest of the class switching off. Like he'd ask a particular question and you could see like everyone's shoulders slump. He was a modern monetary theorist, sort of like junkie. He just loved it. And I'm just, so, not now. We've got to remind ourselves of the central mission, and so we don't lose those other students. Okay, I think there's a lot of conventions that we sort of have internalised about how exchange rates are communicated, but I think there's a heap of potential for confusion about this. What is meant by these numbers here? We can all read this sort of stuff, and this is like for everyday people. This is not for economic specialists, financial specialists, or whatever. This is like designed for ordinary people, but it's not self-explanatory. So something like OneNote you can easily annotate here. So what's missing here? It's one Australian dollar can purchase this many US cents, this many Euro cents. What's the arrow mean? Well, it can purchase more than it did yesterday or the day before. So just getting some of those conventions across, and then it's like, I get it now. I can understand those things. And some kids will get this on their own. But I do think it's important to explain these kinds of things for those that don't quite get it without that little bit of a prompt. Something about these conventions is that they vary. So you go on a Travelex website, for example, it doesn't say how many cents you get. It doesn't say, but it's how many dollars. Instead of saying 64 US cents, you're getting 0.6 of a dollar. The students need to understand that these conventions are applied in a flexible sort of way, and that they sort of just need to change their mindset. And here we haven't just got one exchange rate, we've got a cash rate, we've got a travel card rate. What's going on there? Like you watch the Kohler report and they'll only talk about one exchange rate. You go to the airport and you'll see like all these exchange rates. What does that mean? Well, that's an opportunity for discussion. It costs these places, to hold cash. It's cheaper for them to do with it electronically. So there's a real world sort of application of this. It's slightly different to what's represented in the textbook or on the finance report. I think I might be the only person to have done this with this graph. What I did was went to trading economics and I plotted the Australian dollar against the US, and on the same graph plotted the Australian dollar against the US dollar against the Australian. I think I'm probably the only person to do this because it's a rather pointless exercise, but it's illustrative. You're talking about currency pairs. There's a reciprocal nature between these two things. One goes up, the other goes down. Like there, it's a mirror image of each other. It's a good way of getting this point across. Like we talk about the Australian dollar appreciating against the US, where you want the student to think about it from the American perspective. And so it's a zero-sum game. It's win and loss. So doing something silly like this is sort of like, really helps to get those points across. And trading economics lets you do this sort of stuff, like bring up these make your own graphs. You can have a bit of fun with it. You can change the time frame, all that sort of stuff. I think something else that's confusing to potentially the students is that these are on the same day. You've got 66.9 here, and over here it's 64, 0.6458. There's just this extra. There's lots and lots of, traps, opportunities for students to be sort of like confused, for there to be discrepancy between what they're told on one hand and then what they see in a real world context. And so we can sort of we could even go further and look at Travelex sites that have buy rates and sell rates. Again, there's an opportunity to talk about this. Well, how does Travelex make money? What's a margin? All that sort of stuff. It's easy to get hung up on the daily fluctuations. You watch the Kohler report and it talks about the Australian dollar's gone up by 0.4 or whatever it is. But these really don't matter very much. And so I think getting to this idea that the fluctuations over several weeks or months can be really quite significant. It's not that crazy for currencies to change 20%, 30% over the course of 6 months. This happens quite a lot. And what it means to people in the real world. So to make it more concrete, we can sort of bring in solid examples. One example is in the Big Mac is 480 yen in Japan, when I looked it up anyway. And the question is that a lot? Is that a little? Is it a cheap lunch? Is it an expensive lunch? Well, you can show this isn't in our course. We don't have these sort of exchange rate sort of calculations, work out how many Australian dollars a Big Mac is. But I think we're doing our students a favour just to show how simple it is to do these kinds of things. It's about $4.50 with the dollar at 106. So, that's pretty cheap. Apparently, I looked this up in Australia. I haven't had a Big Mac in a long time, but $6.60 is the current price. So, Big Mac's really cheap in Japan at the moment. But if we go back a few months, so we're going back towards the end of last year, when the yen, when the Australian dollar was not quite so strong against the yen, well, still pretty strong, but it was $5.10. So the yen, a Big Mac has become around 12% cheaper in Australian dollar terms in less than a year. Now, that's not a big deal with a Big Mac, people aren't going to sweat over that. But for an Australian tourist that's booking a skiing holiday in New Zealand and accommodation and ski lifts, when you actually go and when you pay is going to make you hundreds of dollars difference. That becomes pretty significant. And then you can scale that up. What if you're a car importer and you're buying cars, you're bringing cars in from Japan? That's going to make a massive sort of difference. So, it becomes a bit more real to students when we point out things like that. Another misconception that I think that students often bring with them is that that imports, that when we travel overseas, it's an import. And when foreign tourists come here, it's an export. Who's found that in their classrooms? I'll say it, but then I'll need to say it again and say it again. And one-on-one, it's just one of these things that students get stuck on. I think we need to be really aware of those kinds of issues where students will have these misconceptions and either work to correct it or mention it. It's a constant challenge. And it's fun. These kids don't potentially know nothing about this sort of stuff. It really is our jobs to sort of to smooth them into that sort of higher level of understanding. So, talk about winners and losers. So Tasmanian exports to Japan, cherries, wasabi, whiskey, tourism, there's other stuff as well. But we can sort of ask them, are they happy with these kinds of changes with the exchange rate? Would the exporters? And in this case, the importers are happy, but I don't think the exporters, cherries are a big thing. The prices that Tasmanian cherry producers get for the first batch of cherries are just incredible. People pay these incredibly high prices for those sort of October sort of cherries. So, But that's giving us an in. They can sort of make a connection between the kinds of industries and businesses that they hear about and they see around them. This is actually missing something here. Scenario is I would say an appreciation or a depreciation. But I can put this on, use OneNote, and I can annotate it live in front of them. I can pass the laptop around and say, what do you think for each of these scenarios? And there's obviously a couple of trick questions there. Non-trade exposed businesses, it'll take a while for someone to sort of go, hang on, it won't make any difference whatsoever to them. But it's good for them to think about how exchange rates affects some people, some winners, some losers, some neutral, some people it doesn't make any difference whatsoever. So it's a good little exercise, and I don't necessarily like detail what I mean by these. I leave them to sort of like struggle and wrestle that out, and give them a bit of hand if they need it. But this is not something that they would be familiar with. But we can sort of think about. There was a question before about hedging, and like if we've got government debt, but it's been borrowed in Australian dollars, that's quite a different situation to an often developing country that can't do that, has to borrow their money. They might be more exposed to those kinds of risks. That's a bit outside the course again, but the kind of, you go there when it's appropriate. I think we all do that. You want to follow where the student interest is, and especially when, like, what the topical news sort of issues are. It's also a really good exercise for getting students thinking about influencing the exchange rate. Like, if we could, which way would we do it? Because there's winners and losers. You're going to make some people happy, you're going to make some people unhappy. So if we were to intervene in foreign exchange markets to influence the value of the Australian dollar, what was the right level? There's no right answer to that. What's it doing here? Okay, getting back to the yen, the Australian dollar appreciating against the yen. So I think, talked before about the Big Mac, and the highlighted bit was the time frame I talked about before. But we can say, look at this, I think over 2.5 years, it's about 25%, and it's obviously bigger than that if we go further. That's a really quite big difference. And I think it's really worth saying this multiple times to students to rephrase what this means. Australians wanting to buy yen or Japanese products can now exchange around 25% less Aussie dollars than they did a couple of years ago. And to flip that around, what it means for Japanese people, for importers of Australian products, and say it lots and lots of times to get the students really comfortable and familiar with that sort of flipping between those two situations. Like the medium and the long-term variations in exchange rates matter heaps, but we often just focus on daily fluctuations and like changes in the Aussie dollar with respect to the greenback. But there's been these really quite big changes against the Japanese yen. I wanted to find a currency that's going the other way. So the Aussie dollar's been appreciating against the yen, but it's been depreciating against the rupee. Well, not over this time frame anyway here that I'm talking about. It's about 7.5%. And again, we can say, well, if Australians want to buy Indian products, or an Australian tourist is going to India, they're going to have to exchange 7.5% more money to buy the same goods. Keep rephrasing that in these different ways, and I think it really, really helps. And so all of a sudden, we're appreciating against one currency, we're depreciating against another currency. It gets more interesting. And I love this exercise, something like this. Like if we've presented this situation where, the Aussie dollar is appreciating against the yen, but it's depreciating against the rupee. Well, what's happening between the yen and the rupee? And they'll work it out for themselves. I'll just leave that up to them, and they'll sort of can infer the relationship between these two currencies. And what I find is that some students will get it pretty quickly, and they'll feel really empowered. They'll feel like, ding, I must get this because I can work this thing out. And I'm not giving them all the tools. They're working it out for themselves. And some kids won't. And I leave it up to their mates to explain it to them, because they'll often do a better job than I will on this. But I think it's a really empowering sort of exercise. And you can do this with the graphs. You can do this just with numbers in a table. It's fun. And then you can ask questions. Well, is it something to do with Japan? Is it something to do with India? Sort of, what's the story? And then we could sort of show a graph like this. So, we could sort of show that here, which one's first? Is Japanese yen. So Japanese must be depreciating against the yen. So just got this. I think if we disregard COVID, things like interest rates, unemployment rates, inflation and GDP data, they don't jump around anywhere near as much as exchange rates can. I was teaching monetary policy in 2018. It was really boring. Just I showed them an 18-month sort of graph, and it's just a straight line, nothing happening. But yeah, we've got a lot of these other indicators that we look at don't change anywhere near as much, except for COVID and COVID rebounds. as exchange rates do. And so that can sort of elicit some questions about, there's this really quite significant thing. Why don't we do more about influencing it? Why do we just let it be? And Jess's talk had lots of good stuff on that. Also about exchange rate factors, we can sort of see how these play out in the real world. You don't have to watch many of the, the finance report sort of segments to sort of see one of these kinds of stories where he'll sort of there'll be this correlation between some news event and a jump in the Aussie dollar. And it could be unemployment data, it could be inflation data. This one's about the inflation data. The inflation data was unexpectedly high. So you could talk about, inflation's high, but everyone was expecting it. No impact on the Aussie dollar. Inflation's jumped up, but it was a surprise. Significant impact on the Aussie dollar. But you could say, what's happening overseas? Political stuff in the US, the dot plot with the Fed, something that, someone in China said, that there's these things that happen overseas that will have this impact on the Australian dollar. And you can sort of say, well, here's our exchange rate factors, and here it is, happening in the real world in real time. And you can sort of pause the clip before, the journalist says whatever's happening and say, what do you think is the reason for this? Someone will get it. Sometimes I think we've got contradictory sort of determinants here. So how we deal with this, I think, is super important for our students. So textbooks tell us that inflation undermines the value of the Australian dollar, but here we've got information about inflation going up and the Aussie dollar's going up. And students will sort of go, what's happening here? The textbook doesn't have that sort of nuance that we can sort of deal with those sort of concerns or questions. And I've had lots of people ask this, and it's a great opportunity to deal with. My explanation would be that they're both true, but they're operating over different time horizons. Because I do this after monetary policy, I can also talk about how, how this feeds in and with inflationary expectations. So, the depreciating impacts of inflation are less of an issue if everyone thinks that inflation is temporary and if the Reserve Bank is going to act in a way to get inflation back down again. But I can only do that because this is my final topic. There'd be benefits to teaching exchange rates early. You'd get those benefits later. It's just different. This is a bit blurry, isn't it? But something else that's distinctive about exchange rates, we've got broad objectives for sustainable economic growth, full employment, price stability, and that sort of stuff. But as Jess pointed out, the value of the Australian dollar is not really what we talk about as stability of the currency has become internal, it's become domestic, it's become inflation. Why don't we do more about it? If the value of the Australian dollar has such a big impact on our businesses and all sorts of things, why don't we do more? And I think that's where students come up with really, really good questions, and you can sort of talk about the trade-offs. You can say we can manage the currency. We used to manage the currency. But all those the buffers, all those sorts of things that we might talk about. For me, we don't have this in our course. We don't have this fixed versus floating exchange rates. But if you're going to talk about floating exchange rates, it sort of begs the question, what is the alternative? And it's worth going there, I think, if you've got the time. Just very, very quickly then, exam prep. This is an example of, we have half of our exam in Tasmania is stimulus, and it's some sort of excerpt like this. And some of these excerpts can be quite frightening to students. They're often, they might be statements on monetary policy, they might be from financial press. But I like to show these before I teach a topic, partly to scare them a little bit, but also to reassure them, we'll be okay. You'll know what this means. You'll understand this. When they say this, well, it just means this thing that you already know about. To try and make it not so scary. And then we've got questions based on these stimulus pieces like this. And I think this is where it's not that hard. These are the highlighted questions, are the actual questions on exchange rates. And none of those questions are actually that hard. Just talked about the relationship between the dollar and the balance of payments. Well, that's a huge topic. It's so complicated, and sort of the answer is it depends. But here, students can just talk about one thing. And so just talk about the balance of goods and services. That's relatively simple to do in that context. They don't have to know everything about that relationship between exchange rates and the balance of payments. So yeah, show the articles. The articles are a bit scary. Show the questions. The questions are actually doable.